Giga Cloud technology stock is down 51% off its high, and in addition to the lower stock price, the valuation appears ridiculously cheap at current prices. That's what management seems to think, and they initiated a massive share buyback program, and they even commented saying that they believe their shares are significantly undervalued. So I'm going to evaluate Giga Cloud technology stock in this video, highlighting why I think this is one undervalued stock that long-term investors should consider adding to their portfolios.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Like I mentioned at the top of the video, Giga Cloud technology stock down 51%, even though it's bounced back off its lows earlier this year. I mentioned management believes the shares are undervalued, and whenever management starts talking about shares being undervalued, I don't place too much weight with those comments unless it also comes with the share buyback. If you believe the shares are undervalued, I want to see you buying the shares. And then, as a management team, I can acknowledge that you believe your shares are undervalued. Otherwise, management is always incentivized to say that their shares are undervalued. It's not like me making a recommendation of a stock. I don't have any benefit from a stock going up. But if you're the CEO of a company, you always have the benefit if the share price increases. So it's always in your interest to try and hype up the share price. And so unless those comments come with the share buyback, I don't place too much weight on that. But Giga Cloud is putting its money where its comments are, saying that they are buying back $46 million worth of its ordinary shares over the next 12 months. And they made this statement on September 3rd, 2024. They also said, along with the statement for the share buyback program, they said, "We believe our shares present a compelling opportunity at their current price, and the repurchases will represent a value-enhancing deployment of capital for Giga Cloud and its shareholders. While we anticipate continued industry-wide economic headwinds in the immediate to near term, they feel the long-term growth expectations are excellent for the company." Now, the other part of the statement is also interesting in that they believe this creates a value-enhancing deployment of capital. Management has the discretion to decide what to do with the company's money. They could have otherwise used this $46 million on making an acquisition or reinvesting in the business, spending it on research and development, but they chose to allocate this capital to share buybacks. That means that they see this as a compelling opportunity to use the money to buy back shares, because there's so many other things management can do with money. When they buy back shares, it usually means that they feel shares are undervalued. Now, this is especially true for growth companies, companies that are increasing revenue, and not so much true for mature companies, because larger mature companies, they don't have very many opportunities to deploy capital, so they end up buying shares sometimes because they don't have anything else to do with the money. That's not usually the case with growth companies, because they do have opportunities for growth, but when they also do share buybacks, that's really optimized, or that really emphasizes how much they believe the shares are undervalued. So in fiscal year 2023, Giga Cloud generated $133 million in cash flow from operations. They spent $87 million in strategic acquisitions, and they ended the 2023 with $47 million unspent. So that unspent money, it looks like they're allocating to the share buyback. But with over $200 million in cash and no external debt, operations generating positive free cash flow, they're well positioned to allocate $46 million to this buyback, meaning they're not stretching to make this buyback. Their balance sheet is in excellent condition, and they're utilizing some of their free cash flow to repurchase shares. Now, I mentioned the company's in growth mode. Between 2022 and the most recent trailing 12-month period, revenue has grown from about 400 million up to 985 million. Now, that included a couple of acquisitions, but for the most part, the company's organic growth is also positive. And the company is generating positive cash flow from operations, 13% in the most recent trailing 12-month period. That's a bit of a pullback from the continuous increases the company was experiencing in the last couple of years, but still over double digits. It's generating sustainable cash flow from operations, and this means it doesn't need to go to investors and ask for more money. It can self-sustain the business, and it also generates cash flow that it can use for repurchases or acquisitions like it has been doing. The company's not letting money sit around, it's putting it to work. And looking ahead, the analysts on Wall Street that are following Giga Cloud technology stock, they expect its earnings per share will grow to $3.63 next year, up from $2.90 this year. So the earnings per share expectations are for solid growth next year. Most impressively, the company's return on invested capital at 39% is excellent, and it's improving. Return on invested capital measures how good a company is at taking investor money and turning it into profits. And what you'd like to see, a general rule of thumb, is for the ROIC to be greater than the WACC. So that means the return on invested capital should be larger than the weighted average cost of capital. In those scenarios, you're creating shareholder wealth. Giga Cloud Technology certainly doing that. Even though I haven't precisely calculated the company's weighted average cost of capital, as a growth company in its market, its weighted average cost of capital is going to be somewhere between 10 and 20%. And when you have a return on invested capital at close to 40%, you're comfortably above your weighted average cost of capital. And at 39%, it's one of the more excellent return on invested capital numbers that you'll see for a company of its size. And we already saw from the company's statement that they have no external debt and they have more than $200 million in cash. So the net long-term debt is negative because this is debt minus cash. And so they don't have debt and they have cash. So the balance sheet is in pristine condition as well. So if, like the management highlighted, those near-term headwinds persist for a little bit longer than expected, it shouldn't be a major disaster for the company because they have the cash, they have the balance sheet, and they're still generating cash flow with the sufficient enough margin that they can withstand these near-term headwinds and even capitalize on the near-term headwinds to better the company's long-term prospects. And finally, this stock is trading at a ridiculously cheap valuation. A forward price to earnings of 5.9 is very, very cheap for a growth stock with its prospects, with its cash flow growth, with its revenue growth, with its return on invested capital, all of which points to a company that should be trading at a more expensive valuation. So being able to buy it at its current valuation, I think, provides an opportunity for long-term investors. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.